When risks rise, the stock market falls. But once the market adjusts to the higher risk, the expected future returns improve substantially. At least that's the way the theory goes. So today, what does the theory say about the future returns of the stock market? Here's one answer from the Journal of Financial Economics, based on a study by Darien Huang, a former finance professor at Cornell University, and Mete Kilic, a finance professor at the University of Southern California. They found interesting promise using the ratio of gold's price to platinum's price. So, let's take a look. In the study, the two found that increases in the price ratio of gold to platinum, the stock market's expected future return is higher. With the decrease in the price ratio, the stock market's expected future return is lower. And here's the explanation. The ratio is a sensitive measure of risk because gold responds to different factors than platinum. The price of platinum reflects changes with industrial demand. However, gold reflects changes in industrial demand, but also responds to investor demand for a safe haven asset. Therefore, it's possible to isolate the investor's motivation in looking for a safe haven. When the ratio rises, investors believe the market risk is rising. In order to deliver a higher than average expected return, the stock market has to fall or at least rise at a slower rate. This will provide the higher expected return. So that's exactly what we have. The study concluded that the ratio does a good job of forecasting the market's return over the subsequent 12 months. So, as this chart shows, and at the far right of the chart, with the increase in the ratio over the period of late February to late April, we may have good news for the next 12 months. Based on the econometric model, the increase in the ratio means that the market's expected return is more than 12% higher than it was just prior to mid-February. But remember, no model is perfect. In this case, the model failed to signal the recent bear market. Although the ratio did decline from last summer to January, the decline only indicated a reduction in the 12-month expected return of about 5%. Overall, the ratio, though, has been fairly reliable. According to the researchers, since 1975, the gold-platinum ratio has had a significantly better track record when predicting the stock market's subsequent one-year return than 9 other well-known indicators that researchers previously found to have predictive ability, such as the price-to-earnings ratio, the price-to-sales ratio, and the price-to-book ratio. Understand that the stock market's expected return over the next 12 months is not going to be a straight line up. The increase corresponds to the heightened risk in the market. That also means volatility. We've all had a healthy dose of that recently. Always remember that to have above average stock market returns, there is always risks. A bit of trivia for you. See the trader in this photo? He's been on the floor of the NYSE for decades. But talk about risk versus reward. He has never bought any stock for himself. And so for today, that's ChewDog Charts. Thank you.